All right, so on the program this evening, we are returning to the good old flexible endowment plan. All right. Now, here is an illustration. Michael, a 35-year-old businessman, has been thinking of how he can guarantee protection not just for himself but for his family. So he encountered Laulu, who is an expert in life insurance underwriting during a training program on flexible endowment product by ICO Insurance. He's interested in the product, and later he approaches Laulu to just seek for further clarifications on this product and its features because he's prepared to put in for a 30 million naira 15-year plan. Now, take note of that. 30 million naira 15-year plan is what he's really gunning for. But let me bring in someone who can talk us through that. Joshua Gbadebo has been with us, and he's been our lecturer for 3-4 weeks now. He's connecting with us via the phone this evening. Joshua, good evening.
Yeah, good evening, Victor.
And how are you
Nice
doing?
to have you once again this week. I'm very fine.
All right, then. So let's just take it up right away. So what is the product that we are making reference to this evening? What's it called?
Okay, so the product we are looking at today is a flexible endowment plan.
Right. And what do you mean when we say flexible endowment plan?
So flexible endowment plan is a policy that combines both protection and investment together.
Okay. So protection and investment.
Yes, please.
So here we're talking of protection being the angle that covers you as an insurance policy, and then investment means that you are putting your money there because you want to make returns. Is that the way it is?
And yeah, something like that.
All right. So what are its basic features?
Okay, so the basic features is that there's a guaranteed payout at a regular interval. That is 1/3, 25% of the surface amount, which is sum assured, 1/3. Second third of the duration of the policy, another 25% of the sum assured, then 100% at maturity.
Wow. So within that period, you'll be getting, 1/3 of the policy duration, you'll be paid 25%. Another 1/3,
Yes.
you'll be paid another 25%.
Yes, and two-thirds of the duration, another 25%.
Wow. It's sounding too good to be true, really. But what are the additional features?
Okay, so the additional feature is that it makes full payment should death occur during the policy term of the contract. So if death should occur within the duration of the policy, the sum assured, which is the face amount, is paid. There is a duration. We have 6 years, 9 years, 12 years, and 15 years.
Okay.
The annual reversionary bonus is payable for every payment on the policy at maturity. So in case of death, the premium that's paid that when due would also enjoy this reversionary bonus. We also have cash value on the basic policy and the declared reversionary bonus. Also, 70% of cash value are loanable to customers on this policy.
Wow. It appears that it's having so many things that are embedded inside just one policy. But let's just break it down now, Fali. So you're saying now that peradventure, the policy holder is picking up a 9 years or perhaps 12 years plan. And let's say 4 years into that plan, something happens, he passes on. You're saying that the sum assured, let's assume the sum assured of 15 million or 20 million is the guaranteed sum. So you're saying that 4 years into that plan, he passes on, that 20 million naira will be paid to his beneficiaries.
Yeah, so based on this example you gave, I would like to even reiterate what other benefit is there. Remember, we talked about the 1/3 of the duration, and I'm looking at a 12 years plan. A customer that has paid his premium for the first 4 years is already due for the first partial maturity.
Okay.
So in the case of death after the first payment of the first 4 years, death benefit, which is the sum assured, plus partial maturity will be payable to the beneficiary.
As well, and partial maturity will also be paid?
Yes, in as much the premium were paid to date upon death.
Wow. Now, partial maturity here will be 25% of 20 million, right?
Yes, please.
Let me see. That's like 5 million.
Yes.
Will be paid in addition to the 20 million.
The 20 million, yes. And also the reversionary bonus as explained earlier, in as much the customer pays the premium as at when due, will also be enjoyed for those period payments were paid.
By the way, you're making some people's ears twitch this evening. No? Are you sure this is true? Because I'm sure when it comes to investment, people don't joke without this one. These returns you're talking about sounds too good to be true.
Yes, and that's the reason why it's termed flexible endowment plan, because we tend to look at it that, okay, we are looking at covering the life of a customer.
Right.
Then I know most question on the mind of most customers is that, why am I putting my money here? Won't I get something else? So that is why this plan was designed.
Lagos, I hope you're listening to this. Let me see if I can bring in Oluwatumininu Ogunshola. Are you there?
Yes, please. Good evening.
Good evening. How are you doing?
I'm fine, thank you.
All right. So Joshua appears to be attracting the ears of people this evening because we're looking at a kind of policy that is bringing maximum returns in terms of investment. And it looks as if you're putting in little to get so much. And we're just at the point where he's been talking about the additional features. But I need you to just add your voice to it. So is the cover granted under the policy extended to some other riders or even covers? And if that's the case, what do we mean by riders?
Okay. All right. Thank you. So yes, the cover is granted for the extended riders. And then these riders are additional covers that are provided under this policy for more benefits to the policy holders. So the riders that we have on this particular policy, we have waiver of premium, we have permanent total disability, and we have accidental death disembowelment and weekly indemnity ride.
Okay.
So let me just explain them one after the other. So the waiver of premium, this comes into force when the policy holder is unable to perform his normal duties, like he's unable to go to work, he's unable to do anything, he's due to accident or critical illness. And then this cover comes in for a minimum of 6 months. But payments that falls due after this period are waived, and then the policyholder is not charged at all.
Okay.
So if this continues, so the payment is being waived. So also we have permanent total disabilities, just as the name implies, permanent total disabilities. So this is just like a loss of a body part. So, and then the policyholder is unable to complete his work again, is unable to go to work, like probably like a total loss of the eyes of both hands and both legs. So this particular one, yes, that's another rider that we have. And then we have accidental rider. So this one also covers for loss of the part of the body. Okay. And then this one, the total sum assured that is benefits, like the highest sum assured for this particular one is 2 million for this particular one.
Okay, then. So Joshua, are there other types of riders that's under this flexible endowment plan? Do we have other riders as well?
No, she has mentioned everything.
Okay, she has enumerated them.
Yes, she has mentioned everything. Okay. Just 3 additional to the policy itself.
Right. Okay, so these riders, I know she has touched down on it. She has been able to also reflect. But how would the waiver of premium, that's the waiver of premium rider, how does it come into play on this particular policy? Joshua, I need you to break that down for us. Okay,
so the waiver of premium speaks to when there is an accident that involves that prevent the customer, the policyholder, from performing his normal duty, and as the result, the company steps in the moment we've confirmed that this claim is actually true. For the period that the customer will be fit back to work, the company steps in, and premium payable will be taken charged by the company.
Okay. All right, then. So what would the accidental indemnity and dismemberment rider, what does it give to this kind of policyholder?
Yes, so what it gives to them is that in a case whereby there's a loss or part of the customer's body from an accident in line with the schedule indemnity attached to the policy, there's a form of probably might be loss of arm, loss of finger, toe, leg, eyes, etc. But the maximum amount payable here is 2 million. And in a case whereby a customer died as the result of an accident, after paying the face value, which is the sum assured, let's use the earlier amount spoken about, 20 million.
Right.
The sum of 2 million naira would be paid in addition to the sum assured paid to the beneficiary because the death was as a result of accident.
Wow. So that particular accident has been covered as well?
Yes.
Oof. All right. Too good to be true. Lots of benefits embedded inside the flexible endowment policy. Oluwatimi, quickly before we go on this break. So I know you've touched on the permanent disability rider. You've explained something about it before now. So how much would the partial maturity benefit be on this kind of a product? Let's assume we're still making reference to, Michael earlier on, who is seeking a 30 million naira for 15 years.
All right, thank you very much. So for this 30 million sum assured, that's fixed amount. For the first partial maturity, the 25% of the 30 million we paid, which is 7.5 million. And then the second partial maturity, that will be the 10th year. The 25% of that same 30 million we paid, which is 7.5 million. So like a total of like 15 million for both partial maturity.
Wow. That's huge. Lagos Traffic Radio 96.1 FM. This is Insurance on the Move. And today we're touching down on an insurance policy that guarantees not just protection, but of course, investment returns too. So it's a 2-in-1 kind of policy. And I'm sure you'd like to tap into this. We're going to take a short break right now. When we return, we'll be finding out from Oluwatimi and Joshua what happens if the policyholder does not collect any partial maturity on a due date. I mean, they've been talking about partial maturity all since. And then we'll also be finding out what do we mean by reversionary bonus and how much does it cost. All right. All this and much more will be part of the menu. That will be after this brief break.
A friend who'll be there through the sun, through the rain, and a friend you can trust all the way, every day. Live your life, we've got your back, and so I will take you there all the way, every day. Yeah, stop it.
Insurance, your stable friend, yesterday, today, and always.
Lagos Traffic Radio 96.1 FM. Insurance on the Move is a program, and I still have on the phone line this evening Joshua Gbadebo and Oluwatimi Ogunshola, both of them from ICO PLC, and we're touching down on the flexible endowment policy. Let's take you through the routes right now. The return journey making use of the Third Milan Bridge, even though it's good, but of course from Ilaje all the way to Yanoworo, connecting Ifako. It's a slow and steady movement this evening. Nothing unusual, high influx, lots of you making use of that corridor. We'll be serving you more airplanes. But let's get back to the focus. Flexible endowment plan is what we are referring to. All right, so you talked about the partial maturity and all of that. So what happens if Michael refuses to collect partial maturity on the due date? What will happen, Joshua?
Okay, so in a case of that, when partial maturity is due, the customer has two options, either to collect it or to invest it. So what it means is that if the customer is not collecting it, and that when it is due for collection, they will invest it, and by point we're paying it with interest.
Oh, okay. So that's what happens.
Yes.
All right. 09153877127. If you also want to add your voice to the conversation this evening, feel free to do so. 08099120777. Hello. Good evening.
Yeah, good evening.
What's your name?
My name is Steve.
Steve?
Steve.
Okay, that's Steven, right?
Yeah.
Steven, I'm sure your ears must be twitching with all these investment plans they're talking about this evening.
Hell yes.
All right. So what's your question then?
So I have two questions.
Okay.
The first question is someone with an irregular income, not a salary earner.
Okay.
Can such a person benefit from this flexible endowment plan?
Okay, irregular income. All right.
Then secondly, let's say such a person can benefit from the plan. If if I'm on the plan and I need funds urgently, is there a loan or partial withdrawal?
Oh, good. Okay. All right. Thank you so much, Stephen.
Uh,
All right. That's 2-in-1 kind of question. Joshua, somebody with an irregular income, can he really take up this policy?
Okay, so one thing is that we tend to look at the customer, the prospective customer, and we tend to look at the income. If you are saying irregular income, I believe that there should be an average. And that's the reason why we have different frequencies from annually to semi-annual, quarterly, and monthly. So we would work out which of the frequency will be suitable for the customer.
All right. All right. And then it says if he needs a loan, can he pick up a loan?
Yeah, so the policy actually gives room for loan. However, the policy might have been serviced for 2 years.
Right.
And the loan that will be given will just be 7% of premium paid.
Okay.
70% of premium paid.
All right, let me see if I can take this. Hello, good evening. Okay. 08099120777. I don't know if the noise is coming from your end. You need to just stabilize yourself. But what do we mean by reversionary bonus?
All right, thank you very much. Reversionary bonus is like a loyalty bonus to the policy holder's commitment to the policy. So it is paid along with the maturity or either the death benefit. So it is just 4% of the sum assured. That's 40 naira per thousand every year of that particular policy. So like it's just like Michael, that its sum assured is 30 million naira. So it is 4% of that 30 million naira. So and if Michael pays as at when due for the whole of that 15 years, so what Michael will be getting per annum is 1.2 million. And then so the total reversionary bonus at maturity will be 18 million for in case of Michael.
Wow. 80 million.
Yes, 18 million.
That's huge. Okay, so let's still break down some other terms here. So I know you've said this. How much can be granted as a loan on this policy, Joshua?
Yeah, so as I said earlier, so the cash value after premiums of on the policy for 3 years, the policy already has cash value. So depending on the year that the customer intends getting the loan, 75% of the cash value on the policy will be given as loan facility to the customer.
How many percent?
75%.
75?
Yes.
Can be given as loan?
Oh, sorry, 70%.
Oh, 70%. That's even huge.
Yes.
All right. So,
yes.
Stephen, I hope you heard that. We can still even get as high as 70% as part of the loan for this particular policy. All right, then. Let's see if we can take some calls. 08099120777, 09153877127. This one says, good evening. Is this type of plan more suitable for long-term or short-term financial goals? Yinka is sending this one in from Ogudu. Joshua, is it suitable for long-term?
It varies. So depending on the choice of the customer. So like I said earlier, we have different durations. We have the 6 years plan, the 9 years plan, the 12 years plan, and the 15 years plan.
Okay.
So depending on what the customer wants, you can pick any of the duration that suits his desire.
Okay. Another question here says, good evening, Lagos Traffic Radio. I am Bosun. Say, please, what's the ideal age or life stage to start this policy?
Yeah, so the ideal age for this policy is 22. So a customer from 20, and we believe he or she is working and as such can take up the plan.
Okay, so 22 years.
Yes.
All right, this one says, good topic, Victor and Aiko. Please, my question is, what happens if I miss a premium payment? Does the policy lapse immediately? Chinyere is sending this one in from Ilezik. Chinyere, thank you so much. So what happens? Will the policy lapse?
Okay, so in a case whereby the policy lapse, there's something we call grace period, in which the customer has the grace of making up paying up his premium before the policy completely lapses. So for annual frequency, it is 30 days. For semi-annual, it is 21 days. For quarterly, it is 14 days. While for monthly, it is 7 days.
Okay. Somebody is asking here if you can pick up multiple flexible insurance plans at the same time. Is that possible? Can someone buy more than one policy?
Well, we tend to discuss with the customer to know the reason behind it. Then we can then facilitate if we take it or not.
Right. Let's get back to this. So, cash value. What do we mean by cash value?
So, when we speak to cash value, it speaks to the premium that the customer has paid on the policy. Remember, we are looking at the face value of specific sum assured. And as such, premium paid determines the sum assured that we got in at the end of the day.
Right.
So when a customer has completed his premium for 2 years and above, the policy automatically accumulates cash value.
Okay. Now, the very big question here is, can a policy like this, as juicy as it is, Joshua, I do not know whose phone is making us at the background. I don't know if it's Oluwatimi, but you need to move. But as juicy as this policy is, can it be surrendered?
Yes. Okay, Tomini, go ahead.
So yes, the policy can be surrendered after the policy has been maintained for 2 years. Like the premium payment has been paid for a whole 2 years. The policy can be surrendered. That's when the policy has acquired cash value.
Okay, after 2 years.
Yes.
So will you advise any policyholder to surrender this kind of policy, Joshua?
At the point of surrendering, we tend to engage our customers to know the reason why they want to surrender. And that's the reason why we made availability of loan to customers, so that instead of opting this investment plan with protection, they can also have access to the loan on the policy, whereby they can be making they can pay the installments of the loan gotten from the policy. So in this case, we've been able to reduce the turnaround of surrender of the policy, because the essence of the policy is to ensure coverage and also ensure investment on the premium paid by the customer.
Okay, so I just need you to give me a summary of this now. So Michael has chosen a 30-year plan, a 30 million plan, and that's a 30 million sum assured for 15 years. So what will be his annual premium? Quickly, how much will he pay?
Okay, so because of the age of the customer, so the annual premium for the 15-year duration will be 2,767,800 naira.
Wow, 2 million annually.
Yes, sir. 2.7 annually.
All right, so for anyone who wants to pick up this policy, where can they get it quickly as we round off?
Yeah, they can go to our website, icoinsuranceplc.com, and they'll have every necessary information there. And they can also go to any of our offices in Lagos or outside Lagos to also make inquiry. Okay, then.
We'll leave it at that for now. It's nice having both of you. Oluwatimi, thank you so much for connecting with us.
Thank you so much for having us this evening.
And Joshua, it's nice having you too.
The same here. Thank you for having us this evening. Okay?
All right. I'm sure you've given some people some food for thought this evening on how they can really, really put their money where it can be of great benefit to them. Thank you to both of you. We have to go. The program has been produced this evening by Taiwo Barua, and I say a big thank you to Definite Media Concept for putting all of this together. Next week, Thursday, 6:30, the program makes a return. But till then, I'm Victor Oteri. Have a great evening. Bye.
There's a friend who'll be there through the sun, through the rain, and a friend you can trust all the way, every day. Live your life, we've got your back, and so I will take you there all the way, every day. Yeah, stability assured.
ICO Insurance, your stable friend, yesterday, today, and always.